Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets buried in finance reports, and today we're diving deep into the latest SEC filing from World Funds Trust, a report that might seem dry but holds clues about how big money managers are playing the bond market. Now think about this. We're looking at a report that covers the performance of two specific bond funds, Curasset Capital Management Core Bond Fund and Curasset Capital Management Limited Term Income Fund for the fiscal year ending the 30th of September 2025. It tells us how these funds performed, how much they cost us, and what exactly they invested in. Let's start with the Curasset Capital Management Core Bond Fund. For the period from the 1st of October 2024 to the 30th of September 2025, this fund returned 2.71%. Now that might sound okay, but it actually fell short of its benchmark, the Bloomberg US Aggregate Bond Index, which returned a slightly better 2.88%. So basically they made a little less money than the market average during that year. They mentioned that holdings in agency credit risk transfer securities, high yield corporates, and collateralized loan obligations contributed to relative performance, which is jargon for saying they took some bets on riskier stuff that paid off a bit. But then they also said excluding agency mortgages and security selection in asset-backed securities partially detracted from returns, meaning some other choices hurt their performance. Now let's talk about cost for a hypothetical $10,000 investment in the founders class. Shares it cost $36 for the year, which is 0.36%. That is pretty low for a mutual fund, so the fees themselves are not the reason it underperformed. Looking at where the money is invested, this core bond fund has a chunk in asset-backed bonds at 39.35% and another big piece in treasury notes at 34.59%. Corporate bonds made up 20.70% of the portfolio. This shows they are heavily invested in debt instruments across different sectors. For the core bond fund, the total net assets were over $281 million and they held 288 different investments. The advisory fees alone for the year amounted to nearly $1 million, which is a substantial amount. Now shifting gears to the Curasset Capital Management Limited Term Income Fund, also for the year the 1st of October 2024 to the 30th of September 2025, this fund returned 4.47%. This one actually did better than the Bloomberg US Aggregate Bond Index, which returned 2.88%. However, it slightly trailed its secondary index, the Bloomberg US 13-year Bond Index, which returned 4.71%. So similar to the core fund, it beat the broad market, but not a more specific short-term bond index. For this fund, with a hypothetical $10,000 investment, the cost was $45 a year or 0.44%. Again, not a bad fee structure, but performance is key. This limited term income fund is heavily weighted in treasury notes at over 41% and asset-backed bonds at almost 44%. This suggests a strategy focused on government debt and bonds backed by assets. This fund is even larger with over $356 million in net assets and held 282 investments. The advisory fees for this fund were over $1.5 million. That is a significant chunk of money going to the investment manager. Now for the really juicy part, the actual holdings, these tables are where you see where the money is really going. For the core bond fund, we see thousands of dollars invested in specific asset-backed bonds like AIMA, Credit Accept Receivables Trust the 13th of June 2028 with a 4.850% interest rate. They also have extensive holdings in Government National Mortgage Association bonds and various Federal Home Loan Mortgage Corporation securities, showing a strong focus on the mortgage market and government-backed debt. It is interesting to see how much they have in these long-dated mortgage securities, for example, Federal National Mortgage Association, the 25th of November 2046 with a mere 0.114% interest rate. This indicates a strategy taking advantage of lower yields on safer long-term assets, or perhaps hedging interest rate changes. When you add it all up, asset-backed bonds for the core bond fund total a massive $110 million, which is nearly 40% of their portfolio. Looking at the statement of operations, we can see the income and expenses. For the core bond fund, interest income was over $13 million, while advisory fees were just under $1 million. This resulted in a net investment income of over $12.5 million. However, when we look at realized and unrealized gains and losses, they had a net realized loss of over $5.7 million on investments and futures contracts. So the fund actually lost money on investments themselves before accounting for income. At the end of the period, the core bond fund had net assets of over $281 million. Digging into the notes, we find some critical information about how they value their investments. Most of it is level 2, which means they use observable market data, but a significant chunk of asset-backed bonds and corporate bonds are valued using level 3 inputs, meaning the fund manager's own judgments play a bigger role. This is where the risk can hide. It is also important to note that the advisor Accession Capital Management is waiving some of its fees to keep expenses down. For the core bond fund, they waived over $349,000. They can recoup these fees later if the fund performs well enough. This is a common practice to make funds more attractive, but it does mean future returns could be impacted if those fees are claimed back. The independent auditor Cohen Foyne-Tiamp Company Ltd gave an unqualified opinion, meaning the financial statements are presented fairly. That is good news, but it is important to remember auditors check if the numbers are correct, not necessarily if the business strategy is sound. So what is my take on all of this? World Funds Trust, through its Accession Capital Management funds, is heavily playing in the fixed income space, particularly with asset-backed securities and treasury notes. The core bond fund underperformed its benchmark, which is always a concern for investors even if the fees are low. The limited term income fund did better, but still marginally lagged a more specific index. The extensive use of level 3 valuations for a significant portion of their holdings in asset-backed and corporate bonds introduces a layer of risk investors should be aware of, because fair value can be subjective. The fact that the advisor is waiving fees is a positive sign for investors in the short term, but they should be aware of the potential for recoupment. Overall, these funds are navigating a complex interest rate environment, and while they are generating income, the performance against benchmarks raises questions about their active management strategy. Now, I want to hear from you. What do you think about these bond fund strategies and their recent performance? Let me know your thoughts in the comments below. If you found this analysis helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more deep dives into financial documents. And don't forget to join our growing community on Discord, link in the description. Thanks for watching, and I'll see you in the next video.